Do you just assume, Dr. Hildebrand, reversion to the mean rather? Do you just assume, like every other series, we come back to normal in 2018?
I would, what matters for investors is the long term. And if you look at that question, what is key is where interest rates will ultimately settle. I think most reasonable observers assume today still, and I would put myself in that camp, that we're probably going to be in a kind of lower for longer environment for some time. I don't think we're going to see any sort of extreme form of secular stagnation the way Larry Summers and others kind of put it out initially. But it is certainly likely that interest rates will not re-equilibrate at the previous levels before the crisis. That will mean the discount rate will be lower, and that means, of course, that long-term your capital market assumptions, what the market will yield, will be less than what we're used to. And this reflects itself in our own capital market assumptions that we're putting out. If you look at those, what they will tell you that sort of 5 years forward, we're looking at sort of 60-40 portfolio, generating somewhere around between 4 and 5% return.
Wow.
So we remain in a low return or a lower return environment, and these numbers that we're seeing this year and last year should not deflect from that. Now, if again, the key question will be, where will the risk-free rate be? Where will neutral?
Exactly. Do we know?
Where will the equilibrium? I think look, we don't know. This is not observable, but I think there are lots of reasons to expect rates to remain lower for longer. This has to do with demographics, first and foremost. It has to do with high debt levels. Again, I think the high savings numbers that I put out in the beginning is important in this context.
Yeah.
This sort of shows that there are a number of structural forces that are likely to keep rates lower going forward.